When I was a kid, the whole idea of education to me was just to go to school, read books, do my homework and study my lessons to get good grades. That's how my parents and teachers have taught me. But as I grew older, I have learned that education and schooling are two different things. Education is a lifelong process. It is something that happens inside the mind of a person. It is not dependent on classrooms or teachers. It usually starts with curiosity and a search for information. Schooling rarely encourages this. I remember one famous billionaire said this, and I quote, "I didn't go to Harvard, but people who work for me did," unquote. Some of us had lots of schooling, but not much education. Another life skill we weren't taught in school is how to handle money. Just because you didn't learn good financial skills in school doesn't mean that you can't learn them now. Here are some tips you can follow to get better at managing money. The first tip in our list is to make a budget and stick to it. Do you know how much money you spend on things like going out to eat, seeing a movie, buying a cold glass of beer or purchasing clothes? Do you know where all your hard-earned money goes? Most people don't. Go back through your checkbook or bank statements for the last year and write down how much you spent in each category. You will probably be surprised at how much of your money went to non-essential expenses, and how much you could have saved. Let me share with you a simple, yet effective equation which I think even a genius mathematician might still find it difficult to solve. But first, allow me to introduce to you the second tip in our list, which is paying yourself first. Paying yourself first means automatically setting aside money from each paycheck as soon as you receive it, rather than waiting to see what is left over to save at the end of the month. Most people apply the traditional equation to their finances, which often results to reduced savings, or worse, no savings at all. The correct equation that I was talking about earlier was income minus savings equals expenses. Always remember, it's not how much money you earn, but how much money you save. Most of us work every single day to earn money. Some wake up early to attend boring meetings and presentations, just enough to make us yawn 5 times a minute. Others have to adjust their body clocks while loading their veins with caffeine just to stay awake and rush things to meet stressful deadlines. It all boils down to one thing: to make money. With all the hard work and effort that you put into at work every day, it's time to give yourself an incentive. You can start by paying yourself 10% of your monthly income, then gradually increase it to 15 or 20 as you get more comfortable with it. That goes directly into your long-term piggy bank savings. It might seem like a daunting task, but once you make it a habit, you will definitely see the big difference in your finances. The idea of paying yourself is that the money goes toward a long-term goal. It stays in your life in some fashion. Being able to delay gratification is a skill that must be acquired on your road to wealth. If you never acquire this skill, then you will never be able to acquire true wealth. It is integral, because to have wealth, our resources must exceed our needs. When you spend money on short-term fun things, that money just disappears. It goes out of your life. The third tip in our list is to eliminate bad debt. In order to set the stage for your success, you'll have to eliminate any bad debt you may have head on. You may be asking yourself, what is bad debt? Let me explain. Good debt is incurred when you purchase an asset that produces cash flow, or is an investment that will pay off down the road. Bad debt is incurred when you make a purchase that does the opposite, and makes you less wealthy as time goes on. Borrowing money is not a bad thing. If you can borrow money at a low interest rate and use it to earn a higher rate of return, that's good debt. If the money you are borrowing is at a high interest rate, and you are using it to buy things that will not grow in value, stop now. That's bad debt. Increase your assets and decrease your liabilities. Assets put money in your pocket while liabilities take money from it. The fourth and final tip in our list is, have a plan and a vision. Building an emergency fund, starting an investment and planning for retirement are three of the most essential elements of financial planning. An emergency fund is money you set aside for when an emergency upends your world. Having an emergency fund gives you the peace of mind to know that should something truly awful happen, such as losing your job, you can worry about how to deal with the emergency itself, and not worry about how you're going to survive financially. While a person's emergency fund will vary from situation to situation, most financial experts agree that a fully stocked emergency fund should hold between 3 to 6 months of monthly expenses. You can't expect to have a solid financial future if you're not thinking about how to grow your money. For many people, the word investing conjures up images of men in suits, monitoring the exchange of millions of dollars on a stock ticker. You don't need to be the wolf of Wall Street to start investing. It's okay if you're more of a mouse of Main Street. Even if you only have a few bucks to spare, your money will grow with compound interest. The key to building wealth is developing good habits, like regularly putting money away every month. Swap out the barista-made cappuccinos for coffee at home, and you could already be saving more than a few bucks a month. Plans can change, but the important thing is to make a plan. If you can't figure out roughly how long you think you might invest your money for, then you probably shouldn't invest. When you decide to invest your money, you need to figure out how long you plan to invest for. You may not be able to come up with an exact number, but you can probably estimate whether you will be investing for a year, a few years, or longer. There are a lot of types of investments to choose from. Some are perfect for beginners, while others require more experience. Each type of investment offers a different level of risk and reward. People should consider each type of investment before determining an asset allocation that aligns with their goals. What is the first thing that comes to your mind when you hear the word retirement? Being retired means you no longer have all the same obligations as when you were working. It means doing whatever you want to do, regardless of your age. Why would you settle to retire at this age? If you can retire at this age, you just need to know what to do with your savings and investments. How fun it is to be counting your hard-earned money with your best friend while you are still young. Work together with your partner or spouse on the same financial goals, because when you invest, you are buying a day that you don't have to work. It is not rocket science. It's just like anything. If you want it badly enough, you will do it. If you want to make your financial situation better, you can do it, but you just need to start with the decision to do so. Don't forget to like, share and subscribe to Candlestocks to get updated on the latest stock picks every week.